In the decade of the 70s, nominal interest rates rose about fourfold, and the gold price rose 25-fold. It's not impossible for interest rates and the gold price to go up simultaneously if the cause of the increase is the deterioration in the purchasing power of the US dollar, which is precisely, unfortunately, the circumstance I see.
I mean, the collapse of fiat currency is going to have a really enormous impact on how gold and silver are valued. And the way to look at it is it's not gold and silver going up so much. The silver will go up even against gold, measured in what we now accept as real money, what the central banks accept as real money. And remember, these central banks know what they're doing. This is why they are accumulating gold. They're actually selling down fiat currencies.
The global financial system is facing increasing pressure from rising debt, persistent inflation, and growing concerns about the long-term purchasing power of fiat currencies. As governments struggle with massive deficits and central banks attempt to balance growth with inflation control, investors are once again turning their attention toward gold and silver as monetary assets rather than simple commodities. Veteran resource investor rickrule and PreciousMetals analyst Alasdair Macleod explain why today's environment resembles periods of monetary stress seen throughout history. Their focus is not on short-term market fluctuations, but on the structural challenges facing the US dollar, government debt markets, and the broader credit-based financial system. One key argument is that higher interest rates do not necessarily prevent gold from rising. Historical examples show that both rates and precious metals can move higher simultaneously when confidence in a currency deteriorates. Growing federal debt, unfunded liabilities, and rising borrowing costs continue to raise questions about the sustainability of the current monetary framework. As investors search for protection against currency debasement and economic uncertainty, gold and silver remain at the center of the discussion. Let's explore why many believe the next phase of the precious metals bull market could be approaching. We're about to dive into highlights from their interview. Before we begin, make sure to subscribe to the channel and enable notifications so you never miss our latest insights on gold, silver, the economy, and financial markets. Thank you, and enjoy the video.
1967, 1968, it was very clear that the United States was heading into an inflationary period, but nobody paid attention. We'd lived through two very good decades in the 50s and 60s, the nifty 50 and all that, and despite the fact that there was concern about inflation, that concern didn't manifest itself until at least 1972. There had to be 5 years of cumulative and compounding impacts of rising prices relative to wages and savings before the sense of inflation took hold across the American public. Now, it's worthy to note, in the context of the question that you asked, in the decade of the 70s, nominal interest rates rose about fourfold, and the gold price rose 25-fold. It's not impossible for interest rates and the gold price to go up simultaneously if the cause of the increase is the deterioration in the purchasing power of the US dollar, which is precisely, unfortunately, the circumstance I see. I think that Mr. Trump will succeed in jawboning short-term rates lower. But it would appear in the market that the Fed has already lost control of the long rate. They've been doing their very best to buy long-dated debt, refinanced with short-term notes to bring the long-term rate down. But the long-term rate has been really very stubborn. And I think that's a consequence of the fact that the market doesn't believe that America's fiscal problems are in the near term solvable. And I don't think that an appointment of the Fed chair changes that. We owe at the federal level almost $40 trillion in on-balance sheet obligations. And most people don't talk about it, but off-balance sheet, it's estimated by the Congressional Budget Office that the net present value of unfunded entitlement liabilities, Medicare, Medicaid, Social Security, military pensions, federal pensions, it's estimated that that number exceeds $120 trillion. And that's not a nominal number. That's a discounted net present value number. If you juxtapose that $160 trillion in debt with the Fed's $6 trillion balance sheet, it brings the net debt down to $154 trillion. And if you juxtapose that number with the IRS estimate of the private net worth of all American citizens combined at $172 trillion, you'll see that the delta between what we have and what we owe is distressingly small. And what we owe is increasing by $2 trillion a year on balance sheet and $2 trillion a year off balance sheet, which means that the delta itself goes away at current spending levels within 5 years. Now, yes, the government has other assets, but I can't see myself as a bondholder pitching up and saying, Mr. Trump, you owe me Yosemite. The probability that I can perfect against the assets of the United States government are very low. The consequence of that is that you're starting to see in the long rate what is in effect a political risk premium. And I don't see that as being solvable. In fact, I see it exacerbating itself. I see a circumstance where the interest on the federal debt uses up an increasingly important part of the tax base. And I don't see any arithmetic way around that. People often say, Rick, what would get you to sell your gold? And I said, well, that's easy. A balanced budget, including entitlements, and a resolution of $154 trillion in net debt, and positive interest rates, which is to say interest rates on the 10-year Treasury that exceeded the rate in the deterioration of the purchasing power of the U.S. dollar, which I guess from my viewpoint is a different way of saying never.
When you've got what amounts to a collapse in the fiat monetary system, the credit-based fiat system, fiat currency system, there's only one place to go, and that is into money without counterparty risk, and that's gold or silver. I mean, nowadays it's predominantly gold, but silver will have that role as well. And of course, silver has, as we were discussing earlier, this extraordinary situation that even without any demand, monetary demand, the industrial demand for silver outstrips its supply by far. And, with various other factors coming in, like China changing its approach and all the rest of it, which we mentioned earlier, the collapse of fiat currency is going to have a really enormous impact on how gold and silver are valued. And the way to look at it is it's not gold and silver going up so much. The silver will go up even against gold, measured in what we now accept is real money, what the central banks accept is real money. And remember, these central banks know what they're doing. This is why they are accumulating gold. They're actually selling down fiat currencies. It's really these fiat currencies going down, and they'll start going down at an accelerating rate. I mean, just imagine, we're going to get high. I mean, it's absolutely certain that with debt to GDPs of 100% and more, government debt to GDPs of 100% and more, rising bond yields equals a debt trap. What happens with a debt trap is that yields rise even further. It's either that or governments actually balance their books and make sure they're in surplus. Are we going to get that? I just don't see it. This is not what politicians were elected to do. Politicians were elected, if you like, to spend far more than they take in taxes. And, President Trump or Keir Starmer or, anyone, in a G7 country, any politician is not going to cut spending at a time when the economy is tanking as a result of, we can say that as a result of the war against Iran and the closure of Hormuz. I mean, can you imagine it? The job of a government, I'm sorry to say, in these circumstances is to try and support the economy, which basically means that, while at the same time its tax revenue is tanking, it has to spend to try and keep the whole show on the road. What's that going to do?
The outlook for silver appears particularly compelling. Industrial demand continues to exceed available supply, while investment demand is beginning to return as more investors recognize the metal's strategic importance. At the same time, strong buying activity from emerging markets and growing interest in tangible assets are adding pressure to an already tight market. A major theme is the possibility that silver could eventually outperform gold during the later stages of a precious metals bull market. Historically, capital often enters gold first before rotating into silver as broader investor participation increases. This transition can create powerful price movements because the silver market is significantly smaller and more volatile. Another important factor is the condition of the paper precious metals markets. Declining open interest despite rising prices suggests that traditional market dynamics may be changing. If investor demand accelerates while physical supplies remain constrained, silver could experience a substantial revaluation as the market adjusts to new realities. Let's get back to the interview.
What I do know is that in my life, in precious metals bull markets, gold leads. It goes first. And I think that's because the gold buyer is a fear buyer. And in my experience, I'm not saying that this is fact, by the way, this is just observation on my part. When the momentum in the gold price attracts people to the precious metals narrative, particularly generalist investors, when the generalist investors come into the metal space, what happens is that price leadership changes from gold to silver. I surmise, although I don't know, that that's because of the lower unit cost of silver. Particularly poorer people in emerging markets that don't have sufficient financial resources because of the unit price to invest in gold find themselves, particularly in India, investing in silver. And you're seeing that occur right now, record inflows of silver into the Indian market. I personally, and all of this is subjective depending on your own needs and prejudices, I personally save in gold, and I personally speculate in silver. My silver speculation occurred some years ago when silver was hated. And my whole speculative thesis was that we would have a precious metals bull market and that leadership would change from gold to silver. And when that happened, silver would be unhated. That happened in December of last year and January of this year. You'll remember a hyperbolic upchart in silver. When that happened, I couldn't convince myself that silver was hated anymore, which means my reason to own it in the speculative account went away. So I sold 80% of my physical silver. There are other people who might invest or speculate in gold. I don't. I save in gold. It's wealth to me. But I do speculate in silver. And right now, I think the silver stocks are much better speculations than silver itself.
On the basis that gold's going up, therefore silver goes up, gold goes down, therefore silver goes down at roughly twice the pace. But that's actually not the way it should be looked at. The way it should be looked at is this is purely an industrial metal with no premium in it whatsoever for, if you like, speculation about the purchasing power of the dollar, the way in which gold is valued, if you like. So that is something which I think is still ahead of us. I mean, you can imagine if the next run in gold, which I think has been brought forward by the war against Iran and brought forward considerably, what happens then is you're going to get a huge, great clash between the industrial demand and new investor demand. Investors who feel that if you want to play the gold game, then go and buy silver because it goes up twice as fast. And furthermore, you're only paying 75, 80 dollars an ounce as opposed to $4,500, $5,000 for gold. So there is going to be, I think, an enormous bear squeeze on a paper market system which simply cannot handle it. I mean, here we have gold and silver considerably higher than they were over the course of last year. Yet open interest on COMEX is at the lowest levels we have seen in a very long time. I mean, we're talking decades now. When you see a price rise, you expect open interest to expand with a rising price. This is not what's happened. On a rising price, we have actually seen open interest in silver and gold fall. And now gold, for example, I mean, that's recently declined very, very sharply. And it's now roughly 327, 330 contracts, open interest. And I would have said before this that an oversold condition was somewhere around about 400,000 contracts. We're way below that. It's almost as if these paper markets are now irretrievably broken. So coming back to silver, it really does look as if there's going to be a crisis in silver, which could push the price considerably higher. Now, of course, we never know when these things actually kick off. Basically, you're either going to be in it or out of it. And so, my view is that you should be in silver. Don't worry about the short term. Don't worry about it. And when it comes to gold, don't worry about gold either. The conditions are similar, though you don't have the industrial use. It's a pure monetary use. Really what you're doing with gold is you're selling dollars. And selling dollars is the way to look at it. If you want to sell gold, then you're buying dollars. Do you really want to do that? I would suggest no.
The broader message is that precious metals are increasingly seen as alternatives to fiat currencies rather than merely as investment products. Gold continues to serve as a monetary anchor, while silver offers both monetary and industrial demand drivers that could amplify future gains. Predictions discussed throughout the analysis point toward continued strength in gold if government debt, fiscal deficits, and currency debasement trends persist. The expectation is not necessarily that gold becomes more valuable on its own, but rather that currencies continue losing purchasing power relative to hard assets. In that environment, gold remains a preferred store of wealth. silver may present an even more explosive opportunity. With industrial demand already exceeding supply and new investment demand potentially entering the market, the metal could face a significant supply squeeze. If precious metals attract mainstream investors, silver could outperform gold during the next major leg of the bull market. For investors concerned about inflation, debt crises, dollar weakness, gold prices, silver prices, precious metals investing, and wealth preservation, the coming years may prove increasingly important. We'd love to hear your perspective on the ideas shared in this interview. Leave a comment below and join the conversation. If you enjoyed this video and found value in the analysis, please like, subscribe, and click the notification bell to stay updated with future content. Thank you for watching, and we'll see you in the next video.